Hello, hello. So today Lyft announced their earnings and it was a bloodbath. As you'll see, the company is down about 37%, 36.4. And it's weird because a lot of people are actually potentially thinking of adding a company like Uber and Lyft to their portfolio. But I have always been talking about these kinds of companies that are not profitable. You need to be super aware of what they are doing and what their financials are, and not get into the trap of popularity of the company being a super popular company that you want to invest in. It's not how investing works. And so in this video, I wanted to take a look at the earnings report that actually Lyft had and examine the financials of the company, because even a 37% drop could potentially signal a buying opportunity, but it really depends on the financials. Like, is this a company that it makes sense to be investing in? So this is what we're going to be examining in this video, and stay tuned. This is very, very important if you are a new investor. You don't want to invest just by basically hearing what other people are investing in, or the pretty much the famous companies, the worldwide known companies. This is not how you invest. You have to be investing with a mindset of actually making money in the future, and this is what we're going to be analyzing here. Now, first things first, let's take a look at what happened. Lyft shares tank more than 30%, as we know already, after the company issues weak guidance. And you should know that guidance is a super important thing in the Wall Street, because guidance is about what is going to be happening in the next quarter, or in some cases the next year. And so investors are actually taking a pretty hard look at that. And when a company comes back saying that things are looking weak, they really don't like that. And this is when you are looking at companies going down precipitously after pretty much declaring their earnings report. You will see here that the shares tanked after the company said it expects to make roughly 975 million in revenue, which is less than a billion. This is key here in the fiscal first quarter of 2023, lower than the pretty much sort of like threshold of 109 billion. And it's almost like a psychological pretty much threshold here that analysts anticipated according to Street Account. And the rideshare company recorded 20.3 million active riders in the third quarter, effectively flat from the third quarter, but up 8.7 year over year. So they're still increasing their overall riders from the third quarter, but kind of flat from the from the third quarter. That is increasing it year over year. That is. Okay, so Lyft shares fell again because of the earnings per share that was 29 cents a share. That's adjusted versus 13 cents a share. So this is a pretty steep actually win for the company. So they did better in terms of EPS. And the revenue of 1.18 billion versus 1.16. So again, they did better over here. But again, remember, guidance matters because it's about the future, and the Wall Street is all about the future. And so Lyft, as they said that they are expecting 975 million in revenue in the fiscal first quarter of 2023. This is lower than the anticipated one. And so Lyft also expects to make an adjusted EBITDA. So remember, where the companies are talking about EBITDA, it typically means that they're not making profit. And so they're talking about an adjusted EBITDA between 5 million and 15 million, which is like nothing over here. At least it's positive, but it's nothing, frankly, compared to what the stock price is. And we're going to be examining this as well. And I'm going to tell you a little bit more about how this works and a few more details about it. And so, yeah, we're having a guidance basically that helped with the company's insane decline here. And basically, the company is not really making money. Now, let's take a little bit of a look at our tool, because our tool can actually tell us exactly what is going on with the company and whether it makes sense to be buying today after this precipitous decline where it finds the stock at $10. And if you take a look at the 5 years chart, you can kind of see that it used to be like 80 over here, and it's going down and down and down and down, and it's heading down to 10. Basically having a sort of like GoPro stock trajectory. If you remember GoPro, it was a story of an IPO that did fantastic, then it went to almost $100 and then down to like 5. And so this is the same story here with Lyft. And again, it has a lot to do with profitability, because the P ratio is negative, and it has been negative, and it hasn't been positive. And so this means that the company is not really generating net income. And so the question that I want investors to be asking themselves is, what is a company worth to me when it's not making any money? So think about it in your own terms. When a company is not really making any money, you're taking a huge risk if you're actually buying shares into this company, because you frankly don't really know whether they will continue doing well and whether they will eventually achieve profitability. So today you're having specific data, you know that the company is losing money. You don't know what they're going to be doing 10 years from now. You just don't. You can anticipate, you can actually fathom that the company would potentially do well, but you don't really know, and companies can do wrong. And most companies actually that are alive today are not going to be alive in 30 years from now. And so you have to be super careful from companies that are losing money. And so this one is losing money, and it's losing money, as you'll see in the P ratio, in the price to free cash flow. Everything is negative over here, and they are issuing shares as well. So they are issuing tons of shares. And when a company is issuing shares, why do they do that? They're doing that because other investors have fallen into the trap of buying the stock at a very high price, at a price where the P ratio was very negative, like over here or here or here or everywhere, basically. And so the board was, having a meeting one day. They were like, okay, guys, our stock price is climbing. It's like 80, 70, 50. We need to be selling some stock, right? I mean, we need to be making some money, basically financing ourselves through stock, because our operations are not looking that great. Because we do make revenue, again, you can kind of see that here, we do make revenue, but we don't make net income. Like our net income is negative, and it is getting a little bit better at times, but it's still negative. We're losing money. And so if we're losing money, how do we finance ourselves is what the board is talking about. And there are two ways. You either get a loan or you are issuing extra shares, basically increasing the supply of stock by 55%, which is which is nice for the company, but it's super horrible for investors that invested back in 2019, 2020, 2021, because they're massively getting diluted as this keeps increasing. This is why it's very, very important to actually understand the financial metrics of a company, because this will come back to haunt you at some point. And this point is, for instance, now, when the company is actually bidding on earnings, bidding on EPS, bidding on everything, apart from guidance, and the stock is actually down like 40% almost. So this is why you need to be super careful about the financials of the company. It's not about buying meme stocks in the long run. It's about buying the companies that are making good profit, good money for you, and they are cheap to buy today, because you just can't lose when you're buying these companies. You can buy a company like Facebook or Alibaba, which is actually trading down lately, and the stock price has been going down and down and down and down. Yet the company is making tons of money. And so, as you can understand, this has a lot to do with sentiment. It has a lot to do with people trading, pretty much. It's a temporary thing, but things that are actually worthwhile and things that are actually making money, they are not going to be down for a while. But in this case, Lyft, it's losing money, and if it doesn't actually achieve profitability anytime soon, what is this worth? I'd argue that eventually it could even worth zero, because okay, this may be a fantastic business to be buying as a consumer, to be using as a consumer, but as an investor, it's just not making money. It's negative over here. And this is what I wanted to point out. You can kind of see it in the margins here. Also negative, very negative margins. Again, getting a little bit better, but still super negative. And there's nothing to see here. And even if we take a look at, for instance, our stock evaluation tool, I'm going to our stock evaluator, you can kind of see here that nothing makes sense. Like the revenue growth of the company is fantastic. And a lot of people are actually getting into this trap of revenue. Revenue is great, but the most important thing is how much money you can make out of this. Because think of this for a little while. If I actually give you product for free, I can make fantastic revenue. Like if I have discounts, insane discounts, I can make pretty fantastic revenue, guys. I can sell a lot of stuff to you and then lose money. And so this doesn't make sense, because I can artificially increase my revenue, but if I'm not making any money, what is this about? Like a company that's not making any money could potentially be an interesting opportunity for somebody to enter if it's super cheap. But if it's expensive and it's not making money, why are you buying it? Is the question. And so this one has been increasing its revenue, but their net income margins, take a look at this one. They are in negative territory, and very firmly into negative territory. And so what we can try here is just say that the revenue growth of the company, let's just go with like 10, 15, and 20%. Let's just say that the company is going to continue growing at a fantastic pace. But what about the margin, guys? Again, the margins, they're all negative every year. So what are you going to do here? Let's just go with something that is like marginally profitable, 1, 3, and 5%, and the free cash flow margin Again, we don't have numbers. Everything has been negative. So I'm going to go with something that is kind of normal, 80, 90, and 100%, and an annual return of about 13%. And I hit calculate here, and let's see what we're getting. Now we're getting something like $1.5, $6, $13.8, because it has a lot to do with the margins, obviously. Now, if the company starts making margins, then yeah, it makes sense. If it makes like 5%, 10%, it definitely makes sense to buy today. But the company is losing money is the problem. And so where are you buying and why are you buying? Again, the company is nowhere near making any money here. But if they ever become profitable, for instance, they are making margins of like 5, 10, or 15%, which frankly I'm not sure they can actually achieve this kind of business. Maybe 5 for sure, or 10. 15 is probably pushing it quite some. But in that case, if they're making like a 10% margin, maybe it makes sense to buy, yeah, today, for sure. But again, they're losing money, 56, minus 56, minus 59, minus 31 last year. This is horrible. And so what is there to invest in over here? This is why I urge people to be cautious about investing, because you may be listening, you may be hearing about companies that are well known, like DocuSign, for instance, Uber, Lyft. But dig deeper. Are they making money? And if they are not making money, why are you buying them? Like if a company doesn't make money, why are you buying it? It doesn't make any sense. Because investing is about the money that the company is going to be generating in the upcoming years. And if they are not generating money, if they are losing money, then it means they are losing money for you as well. And you have to be super careful. This is what I wanted to make a video about. I wanted to talk a little bit about Lyft because it's down so much, and because this kind of downward trend, it's not the same as with a company like, for instance, Facebook, which has lost a lot of value, yet it's still making tons of free cash flow. It's a completely different case. And do tell me what you think about Lyft, guys, whether you own it, what are you thinking about this one? Maybe buying it later, or potentially selling it if you have been owning it for a while. But thank you for watching, and appreciate you guys, and I'll see you in the next video. Bye bye for now.